Hello, you're watching Deal Flow, the show that keeps you up to date on transaction trends across the African region. We offer you insights from the deal makers, the financiers and the analysts. I'm Erica van der Merwe. Our particular focus this week is to look at opportunities in West Africa, as seen from the perspective of retail giant Shoprite. Here to offer their insights are Wilhelm Hertzog, analyst and portfolio manager at RECM, and retail analyst Syd Vianello. Welcome, good to have both of you. Wilhelm available in our Cape Town studio. Syd, I'm going to start with you. So we've seen this expansion by major retailers, including Shoprite, outside of South Africa, north of the borders. What's the rationale and the particular competitive advantage for these South African corporates?
I think it all has to do with this emerging middle class, because the characteristics of, let's call it West Africa or the rest of Africa, are pretty much the same as what we've experienced in this country post 1994. The let's say the emergence of a much bigger and growing middle class with a lot of money to spend and presumably borrowing capacity as well. And I think what the retailers said to themselves was, well, look, if the characteristics are exactly the same, and we're based in Africa, and this is where it's all happening, why not take up the opportunity and go and try and replicate what we've achieved in this country, go and replicate it in the rest of Africa. And on top of it, we are on the continent, and we have an opportunity to get first mover advantage before anybody in Europe or anywhere else in the world, for that matter, tries to get in there at the same time.
Well, Helen, we'll talk in more detail about the particular Shoprite strategy in West Africa and Southern Africa. But if I were to just ask you generically, what is your opinion on the way in which South African corporates and retail corporates in particular have expanded north of our borders? My understanding is from comments from various analysts is that South African corporates have tended to be quite conservative in their approach.
Sure, I think they have been, and I think it's for good reason. I think many companies have learned the lessons of earlier forays into Australia, into Europe, etc., where many companies burnt their fingers by paying for acquisitions, and acquisitions which in the end turned out poorly. So I think that the growth into Africa has been much more organic, specifically on the retailer side. And I think that's probably the right strategy to follow. You need to probably partner with locals, but you need to be aware of overpaying. I think it's easy to get carried away in this excitement about massive markets and emerging middle classes and rapid growth, and to get carried away in that process and overpay for assets which in the end turn out not to deliver the goods. So I think it's quite appropriate to have expanded conservatively. And even despite expanding in a fairly conservative manner, we do see that the likes of Shoprite are leaders in Africa. So it certainly hasn't held them back in terms of losing market share or allowing other players from foreign countries to gain the upper hand on them. So I think it's been quite appropriate.
Now, established in South Africa in 1979, Shoprite has grown into Africa's biggest retailer. In its latest set of results, the retailer said it's seen business confidence locally in the South African market drop to levels last seen in 2000. Earlier this week, CNBC Africa spoke to Wati Bason, his CEO of Shoprite, and this was his perspective about the South African market.
Yes, there's a shift. We're very worried about the 2% growth rate of South Africa. It has got not problems for Shoprite in terms of its trading, but certainly in terms of its capacity to expand fast enough. We see lesser property developments. I think we're at the lowest for 2016 year for the next 24 months that we've been. But I'm not that negative about it. I think that there may be a coming back to a more realistic growth rate if all the plans of government works out, and if a lot of the people in private industry supports the plans and actually gets down to the most crucial factor that we have, and that's unemployment.
Well, so do you see his perspective on South Africa? An interesting mix, because despite what we're seeing, the low retail growth, and if you look at the South African supermarkets, turnover, they're 8.7% year on year, compared with just under 10% in the previous financial year. So pretty disappointing compared with the 27% growth you're seeing in Africa, excluding South Africa, retail growth. So despite that sort of almost a negative sentiment, and he refers to unemployment and indebtedness of the consumer, in spite of that, still quite an aggressive expansion strategy in South Africa that we're seeing.
Well, that's the piece of the puzzle that's got many analysts quite perplexed, because if you're growing your trading space at a rate faster than growth in the market in real terms, the net result is your existing stores will ultimately, over time, report lower unit sales, and therefore, with rising costs, your operating profit margins are going to come under pressure. Now, in the past, Shoprite and, of course, its competitors have been able to take away market share from the one player who've lost market share consistently for 10 years, and that's Pick n Pay. So, of course, you can kind of get away with rapid expansion because you're taking more market share, and the one offsets the other, and levels the playing field. But of course, that's come to an end, because I think you're seeing now with Pick n Pay under Richard Brasher, you're seeing for the first time that market shares have been more or less stabilized. Bottom line is they're not losing market share anymore, and I think they're going out there aggressively now to start winning it back again. Yeah. So of course we could have a complete turning of the tables are going to be turned completely, potentially, in the future, and that then does potentially put some pressure on your future performance if you're going to carry on rolling out space at the rate that Shoprite has been doing.
Wilhelm, summarising what Syd just said, it sounds as though it's a brave, rather heroic move by Shoprite to stick with their seemingly rather aggressive South African expansion. I think about 92 new corporate stores rolled out this past financial year. Of the 80 new supermarkets they plan to roll out in the coming financial year, 50 will be for the South African market. Would that have been your tack?
I think it is quite brave, as you say, and it's going to be interesting to see how that plays out, because I do think the right strategy for most businesses is typically to try to be counter-cyclical and to expand in an industry downturn. That's typically when competitors are pulling back, when competition for sites and leases is less intense, so you can secure those at better prices. But this is very early in the down cycle, well, potentially early in the down cycle still, and we haven't really seen anyone, what shall I say, pull back in a very meaningful way. So Shoprite's still very confident at this stage. It'll be interesting to see if that confidence persists, if this consumer downturn lasts for another year or two and margins come under pressure and the like.
Now, outside of South Africa, things seem tough too, but perhaps in a different way. When we asked the CEO of Africa's largest retailer about the other exciting regions, he had about 4 that he listed for us.
But Angola, Nigeria, Ghana and Zambia would be probably the 4 regions that accounts for the majority of the, whatever, 911 or nearly R1 billion worth of profit.
And in particular, Wati Bason went on to elaborate why he sees West Africa in particular as the land of opportunity.
And if you go into a place like Angola, you will probably see all the airports have been not just redone, rebuilt in 3 or 4 years. Cities have risen with 3,000–4,000 houses, with new gas fields that were uncovered. And I think it's just something exceptional that is happening on the African continent, especially in the western portion of it, which is the first time that Africa develops in reasonably good clusters where you can put down more than 1 single store or 2 stores and really go for like 100 stores like in Nigeria.
Now, so just listen to that language. He talks about the exceptional opportunity in the continent. And I also like his reference to clusters, his ability to develop in these various markets in clusters.
Well, let's talk about Nigeria. Nigeria is the biggest by far of those 4 markets. Only the other day, well, a month or 2 ago, it was discovered through reworking the numbers that the Nigerian economy is actually bigger than the South African economy. So we are talking about a huge country with opportunity. 150, 160 million people, 3 times South Africa's population. And in terms of existing supermarket capacity, in other words, numbers of stores, amount of trading space that exists in the country right now, virtually nothing. In fact, probably the vast majority of the trading space that does exist is actually controlled by Shoprite in any event. So, I mean, if we're talking, and I think you have the numbers, the number of shopping malls you have in South Africa versus the number that you've got in Nigeria. I mean, it's chalk and cheese.
Yeah.
And you just look at those numbers. Then you can see why Shoprite are talking in such glowing terms about a country like Nigeria.
Wilhelm, I've got those numbers that Syd's referring to now. I believe this is what Wati Pason gave at the presentation. You might be aware of these numbers, but he's saying now the Nigeria's consumer market is about $100 billion US, compares with South Africa, 127 billion US dollars. South Africa has over 2,700 supermarkets. Nigeria, 20. So do you agree that this is a worthwhile opportunity? But it's taken some time, though.
Sure, there is clearly an opportunity, but it does take time. You can't develop stores in isolation. You need infrastructure. You need to be able to distribute goods and inventory to those stores. So you're also dependent on the country as a whole developing. You can't run too far ahead of that. The question in our mind certainly is, in a market like Nigeria, which so obviously has a big opportunity to formalize food retail, will Shoprite capture all the returns on offer, or will the market attract so many competitors that competition becomes cutthroat, rents escalate through the roof, and in the end no one really manages to earn a great return on capital? Because that's what it's about at the end. It's fine to grow, but you need to grow in a profitable way. If you're not earning the returns on capital that beat your cost of capital, you're not adding value to shareholders. And interestingly enough, if you look at the numbers, certainly in Shoprite's numbers, they earn better returns in South Africa, if you look at returns on invested capital, than they do in Africa.
Now, in discussing Shoprite's future, if you look at the different regions, and the regional focus for Shoprite seems to be Southern and West Africa. Wati Pason was very clear on his lack of interest by comparison in East Africa. Let's take a look.
I'm not a Kenyan fan at the moment because we've never been able to do a successful deal in Kenya for the last 15 years. So it's not on our radar screens. It has got a better infrastructure than most African countries, but I think it doesn't have the same potential as the Nigerias, Angolas, DRCs.
So Syd, Shoprite withdrawing from Tanzania, so literally moving away from East Africa.
Yes. When I look at East Africa and I look at those gigantic gas deposits in northern Mozambique, which extend under the sea into southern Tanzania, I would have thought that perhaps Shoprite should have just stuck it out a little bit longer.
Wilhelm, I want to close by asking you to briefly give us your opinion on the valuations of Shoprite. Syd spoke about different perspectives. Shoprite share price down over 10% so far this year. Perhaps the market doesn't like what it's doing. Your views?
Our view is that the market has certainly woken up to the reality that growth doesn't continue forever, and that the South African situation wasn't sustainable, the one that we saw, I guess, from 2010 to 2012. So the valuation is certainly much more realistic than what it has been in the past 2 years or so, but by no means cheap to our minds. I think if you look at the price to earnings ratio, it's in the vicinity of 20 at a share price of about 140, 145 rands. Now that's not low by anyone's measure. And if you take into account that profit margins are still at fairly elevated levels, with probably scope to decrease somewhat if the competitive environment in South Africa becomes a bit more fierce, and if the continued expansion starts to weigh on costs and that getting ahead of revenue growth, then one can certainly see how earnings could be under pressure for some time. And at a 20 times multiple, we think at best the share probably offers fair value, but certainly no bargain by our measures.
Well, Wilhelm and Syd, thank you so much for your insights on Shoprite. Wilhelm Hertzog, who is a portfolio manager at RECM, he spoke to us from Cape Town. And Syd Vianello is an independent retail analyst. From me, it's thanks for watching and a good week to you.